And joining us right now to weigh in on all of that is the president and founder of Potomac Wealth Advisors, Mark Avallone. Mark, good to see you. Thank you so much for being here this morning. Your reaction to this nervousness in the market, you've got to make investment decisions every day. When you see a market down as much as it has been on these worries about slowing growth and higher interest rates, how do you invest?
Well, the slowing growth is mostly overseas. We see a hint of that here with the ADP number. The real trouble today in the market is the news that you've been covering all day. When you have a shocking event like that, you're going to see a reaction, and that's when it's important to look at the underlying economic strength that the U.S. economy still has. We're still in a bull market. The U.S. economy is still strong. The problems are mostly overseas. They're with the Fed and China. The good news about the jobs number that you reported earlier is that numbers like that, which show that growth may have peaked, that could suppress the Fed's zeal to continue to be aggressive, and longer term, that's a positive for the market.
So you want to still then be buying stocks, is what you're saying?
Yeah, I think I'd be cautious here. I would go in slowly. I wouldn't back up the truck right now because there's just too much exogenous news. But look, ever since 1946, the year after a midterm election has been positive. The GDP is over 3%. Unemployment's 3.7%. None of that spells recession. None of that says this is a bad time to be in stocks. But I would go in slowly until some of this news noise calms down.
Mark, you just commented that the below expectations on the jobless claims and ADP may be an okay sign because the Fed may not do as many hikes as we expect. So maybe they'll do 2 next year instead of 3 or 4. But that actually aligns with the idea that people now are nervous about the inverted curve because that shows there's a possible slowdown. So wouldn't that kind of play into what we saw last week?
Yeah, last week was an inversion on the middle end of the curve. We haven't seen that yet in the 210 spread. I'm not sure that's a one-to-one correlation that inversion leads to a recession. We look more at the underlying economic data, and recessions cause stock market corrections, and an aggressive Fed causes stock market corrections with a higher probability than an inverted yield curve. And an inverted yield curve may or may not even happen yet. So I think we're getting a little ahead of ourselves with that worry. And I think any Fed pullback is going to be a net positive for stocks.
So just as a follow-up, going into next year, what would you say how many possible hikes the Fed will likely do at 25 beeps?
It'll be good news if they're data-driven, and I don't think they get to more than 2. December's pretty much baked in the cake at this point, but they've seen what happens when they get more aggressive. And we also see a global overseas slowdown. It's not just they were worried about a wage number early in the year. One wage number doesn't drive the entire global economy. And overseas, there are some real problems, both geopolitical as well as economic and structural. So the Fed is going to face those headwinds. They just can't march to their own drum and raise repeatedly 3 or 4 times simply because we've had a bout of strong wages here in the U.S.
Mark, James Freeman at the Wall Street Journal. I'm wondering if you could try to interpret for us this investor reaction to the Huawei news. Do you think this sell-off is occurring because people think this is Trump jabbing at the Chinese as part of a negotiation? Or if it's a completely legitimate investigation, there's a lot of reason to think it is. If this really is an outlaw company, why should that trigger a sell-off? And can't we have law enforcement even with a trade deal?
Well, I think it's a little of both. I mean, to think this happened while they were meeting at the G20 is a bit surprising. I think it shows how firm Trump and his administration is to fight China excesses. I think that's what worries the market. The markets just want everybody to kiss and make up and for things to be better. And clearly a move like today says that is not going to happen. We are in a prolonged trade skirmish here. The market reaction today is they're worried it's going to turn into a trade war. Most important thing now is for this really to subside. Have some meaningful conversations back channel and keep it out of the headlines because the Chinese don't react well if they look to be embarrassed and publicly humiliated.
You said keep it, Mark, it's Dagan McDowell. You said keep it out of the headlines. So are you suggesting that the communication strategy coming out of the White House and out of Washington, it needs to be, well, more quiet, if you will?
Absolutely. That would be wiser at this point. Look, we've said that before here. These tweets only serve to antagonize a proud country that is intent on being our economic peer. That's the reality. We can't publicly beat them down. I think effective conversations would be far more important than trying to be a bully in the street with the significant economic power that China is becoming and absolutely wants to be.
Yeah, but that's not going to happen. I mean, we're gonna see the news come out as it happens. I have a hard time believing that what happens is going to be quiet, and we're not going to find out the news. So the news is the news. China and the U.S. are in a fight. China has been stealing for us for decades, and there is worry about a global slowdown and that fight having an impact on the relationship. What is the downside risk? I mean, I know you said everybody wants China and the U.S. to kiss and make up, but what's the downside risk of China and the U.S. having a drawn-out issue here?
Well, it would create economic uncertainties. It would shift U.S. production to other countries that may or may not even be able to handle all of the production that's inside China. Tariffs also raise costs to consumers here. It's a global trickle effect. Look at what's happened to emerging market stocks since this. The emerging market stocks are reacting to the uncertainty in China.
I mean, what's the alternative? You know, this president has pushed back on China and its behavior, and he's basically making a statement that, yeah, we are going to protect and force respect out of Beijing for America's intellectual property.
Well, then that's the choice. Do we have the internal fortitude to sit through market gyrations like this, for the president not to look at the stock market as a daily indicator of his success, and for the American economy, for our farmers, to sit through some pain? Yeah. This is going to be the test, because the Chinese leaders will sit through their pain, and they're feeling pain. Look, I think this strategy is working. It's bringing them to the table. It's slowing their economy down, and it's giving us some leverage. I'm not against the objective here. Yeah. I'm just pointing out that along the way there's pain, and we're going to be feeling it.